Compared to many major European economies, UK average wages are lower, and this is before we take into account relatively higher housing costs and the longer working hours for British workers. In the past 15 years, the UK has seen pretty much a stagnation in real wages. If a pre-crisis trend had been maintained, real wages would be more than £11,000 a year more. Apart from Italy, relative to other European countries, UK wages have fallen behind, meaning that on current trends, UK wages could slip further behind other European countries, including Poland or Slovenia. Now, the UK Treasury like to point out that since 2010, UK real GDP compares relatively well to other European economies. Some newspapers report the UK economy is going gangbusters. But if this is a true reflection of the UK economy, why has wage growth for the past 15 years been such a disaster? Let us look at why UK wage growth has disappointed, and whether there's any hope that there'll be much better wage growth in the future. Firstly, let's quickly address the real GDP issue, because it does seem a paradox. UK real GDP growth has averaged around 1% since the Great Financial Crisis, and this, by the way, is way below the post-war trend rate of growth, which was at least double that. But importantly, this real GDP growth has been boosted by high migration and high population growth. If we look at real GDP per capita, the story is quite different. On this metric, the UK performance is relatively weak, and on real GDP per capita, the UK economy is still below the pre-2019 peak. Now, last quarter's GDP statistics were quite promising, 0.6% growth. But before we talk about an economy going gangbusters, we have to put this one quarter's growth into context. Overall, it's been one of the worst parliaments for wage growth since the war, and to regain the post-war trend rate of growth would take several years of positive growth in real wages. Now, the biggest hit to real wages in the past couple of years has come from inflation. Inflation which peaked at nearly 11%, the highest for over a decade. Now, inflation was a global story. Rising oil and gas prices, plus the end of COVID restrictions, pushing up prices around the world. But the important thing is that UK prices have risen significantly more than other countries, even other European countries. For example, prices have risen 22% in the UK, compared to 13% for France. Also, it's a kind of inflation which impacted low-income consumers more than higher-income groups. The biggest price rises were in necessities like energy and food. Food prices rose 40%, and interestingly we saw a 7% fall in consumption of food. No wonder that demand for food banks has soared in recent years. But this all raises the important question, why has UK inflation risen more than other countries? In 2016, the pound fell 13%, which raised import prices back then. However, in the past 3 years, apart from fluctuations like the Trust budget of 2022, the pound has been maintained its value. So this does not explain the rise in prices. Another potential reason is monopoly firms taking advantage of inflation to push up prices even more. Now, there's an evidence that this happened to some extent at the start of COVID, with firms pushing up prices and/or shrinking the size of goods. However, in the past year, UK profit showing it's not just workers are struggling, but also firms are seeing a squeeze of their profit margins due to higher costs and lower returns. UK wages account for around 55% of gross value added of the economy, which is actually relatively good compared to other countries. So if this doesn't explain inflation, what does? Why is the UK particularly sensitive to inflation, causing a big fall in living standards? Firstly, the UK has a strong reliance on natural gas for producing electricity, and the fact that electric prices rose so much was quite important for industry. In France, prices rose 40% less, reflecting the much more generous government price cap guarantee in France, but also the greater availability of other energy sources such as nuclear. Secondly, Brexit-related frictions have pushed up import prices. They've pushed up the price of transport costs and trading. The UK has experienced shortages, delays and higher costs. Researchers at LSE claim that Brexit has caused food prices to rise 30%. So it was a global inflation shock, but these additional frictions and costs caused UK inflation to be worse than elsewhere. But the bad news is that far from getting better, if anything, we've got more bad news to come. This year, new customs and checks at the border were announced, and this could add another 60% to the cost of importing food. One firm importing goods from Eastern Europe claims it will have to pay up to £2,000 a lorry to deal with the new regulations. However, whilst the past few years have been very difficult, it's only part of the story. Why have wages nearly stagnated since 2009? To explain this, we need to look more into the underlying weakness of the UK economy. But first, it is worth pointing out that not all workers have been equally affected. The worst hit sector has been public sector workers. For example, NHS staff such as nurses have seen a fall in real wages of 6%. And this has led to a crisis of recruitment, low morale, and is a reflection of government austerity and squeezes to public spending. Public sector pay is often an easy target for government austerity. On this front, with more planned spending cuts to come in the coming years, it will be hard to reverse this and lead to big real wage growth. There's no sign of any improvement in government finances. If anything, the government's fiscal position is worse than it looks at the moment. Usually, a period of inflation helps to reduce debt to GDP because inflation kind of inflates away the government debt. But actually in recent years, inflation has only worsened the government debt situation, showing how squeezed government finances are. Now, the biggest long-term factor determining wage growth is labour productivity. In fact, productivity also determines all these other factors such as profit margins, economic growth and government finances. Basically, if workers become more productive through the introduction of new capital and investment, wages will tend to rise. But the problem here is that productivity growth has slowed down dramatically. It explains why one of the few countries to have even lower wage growth in the UK is Italy, which has had a productivity nightmare. And the worry is that the UK is starting to resemble that 20-year wage stagnation that Italy experienced. Now, another factor that determines wages is it also depends how long you have to work for. And if we look at output per worker, measured in PPP terms, the UK economy has wages around 15% below that of Germany and the Netherlands. In effect, UK workers have to work longer hours to produce the same amount of output as a German worker. And unless productivity rises, there's little hope of any sustained rise in real wages. Now, in the past decade, there have been frequent forecasts that productivity would regain its past trend rate and regain its past upward momentum. But the problem is there's a whole series of forecasts that failed to materialise, which were unfortunately overly optimistic. Also, it's interesting to look at how British workers do tend to work longer hours, and this has been a concern that firms have been willing to get people to work longer hours without investing in capital and productivity. And in fact, the UK has the lowest level of investment in the G7, which is a key factor behind this poor productivity growth that we're seeing at the moment. Now, is there any positive news for real wages in the UK? At least in the short term, there's some good news. Headline inflation is coming down quite sharply, and whilst inflation falls, workers are temporarily experiencing a rise in real wages, which is very welcome after the past very difficult few years. Now, this of course has to be kept in context of the past 15 years of near stagnant real wages. But secondly, the period of high inflation and high interest rates did cause quite a rise in savings, and many households were actually able to pay off their debt levels. UK personal debts are certainly much better than they were, say, in 2008. And with lower inflation and the possibility of lower interest rates later in the year, consumers do have this source of savings that they're able to spend, and this could lead to relatively good growth in the short term. It explains why the economy has bounced back from that economic recession around the turn of the year. And this will be very significant for real wages. With a high demand, wages should maintain their positive growth. However, whilst this is good news in the short term, the bigger issue is, can we get that long-term regrowth in real wages? Because that will be much harder. A temporary increase in demand is the easy part. The big question is, will firms invest in increasing productivity, leading to sustainable rises in real wages? This is a big question that is uncertain at the moment. One of the few positive trends of the past 15 years is that minimum wages have increased the wages of the lowest paid workers. Bar staff and cleaners have actually seen some of the higher growth in real wages. But this alone can't reverse the UK's relatively high levels of income inequality. And outside of London, the poorest households are significantly worse off than the poorest households in comparable countries such as France. Now, so far we've spent a lot of time looking at real wages, but this in a way is only half of the equation, because no matter what your wage is, it depends how much you have to pay on rent and housing costs. And this is the other big problem that UK workers are facing. Wage growth has been slow, but housing costs continue to rise. This video goes into some of the reasons why the UK has one of the most expensive housing markets in the world. Not particularly enjoyable reading, but it is nevertheless gives an insight into some of the problems the housing market faces.